thoughts on debt mutual funds to protect your money? What? No. They are very risky. I cannot. Not really. When you talk about mutual funds, a risky investment is the first thing that crosses your mind. However, there is a class of debt funds called the liquid mutual funds that are a low risk investment option. These liquid funds serve a very important purpose. They help you build an emergency fund for a financial crisis. People who lose their jobs, meet with an accident, or fall prey to a major illness need money in a hurry. This is where your emergency fund actually protects you, and financial advisors recommend having at least 6 months of expenses in this fund. Hello and welcome. I am Prarthana from Clear, that is India's largest tax and financial services platform. At Clear, we have assisted 6 million plus tax filers so far. By the way, I have an exciting announcement for new subscribers. We have a free gift for you. We have curated 4 of our best calculators that will help you estimate the future cost of your financial goals as well as identify the lump sum you need to invest to reach those goals. To claim it, subscribe to our channel and let us know in the form given in the description box below. A liquid mutual fund or a liquid fund is a debt mutual fund that invests your money in the money market instruments such as treasury bills, certificates of deposit, commercial paper, term deposit, etc. with a maturity period up to 91 days. Let us get a better understanding of liquid funds. Liquid funds invest their assets in fixed income instruments of a very high credit rating and a short maturity period. As these funds invest in securities of high credit rating, they have negligible credit risk, which means chances of defaulting on principal and interest payments are very low. Liquid funds invest in securities of very short maturity of up to 91 days. As a result, they are not affected too much by the interest rate fluctuations in the economy called interest rate risk. Liquid funds are ideal to park your money for a few weeks or months, and it offers returns similar to bank FDs. You can take out your money even on the next day of investing in the liquid fund. However, you may incur a small charge called the exit load on redeeming units of the liquid fund within a week of the investment. You have ideal cash and want to accumulate money for a short-term financial goal. Here, short term refers to a period less than 1 year. You want to park your money for a short time and earn higher returns than the savings bank account. The stock markets are extremely volatile, and you have sold some shares and equity mutual funds at a profit. You can hold the proceeds in a liquid fund until you find suitable investment opportunities. Liquid funds are tax efficient and compared to bank FDs, especially if you fall in the higher income tax bracket. Liquid funds are classified as debt mutual funds. The table shows you how liquid funds are taxed. The takeaway is that the indexation benefit adjusts the gains for inflation using the cost of inflation index as provided every year by the government, thereby reducing tax on your long-term capital gains. However, the interest you earn from bank FDs are added to your taxable income and taxed according to your tax slab. Liquid funds have negligible credit risk and interest rate risk, making it an ideal low-risk investment option. Liquid funds invest your money in government securities and AAA rated securities of public sector companies. Government securities enjoy a sovereign rating. As liquid funds invest in financial instruments with a high credit rating, chances of a default on principal and interest payments are very low. Liquid funds invest in financial instruments with a maturity period up to 91 days. As the duration of these securities is extremely low, they are not impacted by interest rate fluctuations in the economy. However, despite all the talk that liquid funds are a safe investment, they are not completely risk-free. Let us understand which liquid funds are not safe for you. I hope by now you have understood what liquid funds are and why you must invest in them. Don't you want to know how to pick the right liquid fund? If yes, then please type yes in the comment section below. Liquid funds are, after all, debt mutual funds and they do have an element of risk. It is vital that you check the credit quality and maturity period of the financial instruments in the portfolio of the liquid fund. Now, let us understand why some liquid funds are risky investments. Well, liquid funds invest mainly in government securities and AAA rated securities of PSU, that is the public sector units, which are extremely safe. However, they do invest a small portion of the portfolio in corporate bonds and you must check the ratings of bonds in their portfolio. Credit rating agencies such as ICRA, CARE and CRISIL rate the issuer and their securities. The ratings could be as you can see on the screen right now. Government securities have a sovereign rating and are extremely safe. Higher the rating of the issuer and the corporate securities, the safer your investment is. So, what makes liquid funds risky? Some fund managers chase higher returns by investing in corporate bonds or securities of a lower credit rating which offer higher returns. There is a risk of default on principal and interest payments on corporate bonds of a lower rating. Credit ratings can change over time. If a credit rating agency downgrades the issuer or its securities which are part of a liquid fund portfolio, the credit risk increases. You must check the modified duration which is shown in the portfolio of liquid fund. It shows how much the price of a bond changes if interest rates change in the economy. Well, liquid funds with lower modified duration are less vulnerable to changes in interest rate in the economy. Take a look at the investment style of a liquid fund. As you see from the investment style box, this liquid fund has high credit and quality and low interest rate sensitivity. Let us take an interesting case study of the IL&FS fiasco in 2018 that is still fresh in the minds of several investors to understand why you must pick the right liquid funds. Infrastructure Leasing and Financial Services is an Indian state-funded infrastructure company which enjoyed a AAA rating for a long time. So what happened to this highly rated infrastructure company? Well, IL&FS aggressively bagged new infrastructure projects and borrowed to the funds these projects. This was not difficult as the firm enjoyed a AAA rating and could borrow the funds easily. The money would be diverted to repay lenders of earlier projects. IL&FS faced allegations of where some senior executives of top credit rating agencies ensured the company received a AAA rating. Eventually, state-owned shareholders did not provide the much-needed equity to plug the gaps in the funding. Short of funds and facing cost overruns in its construction project, IL&FS defaulted on its bank loans and commercial paper obligations. Well, as a consequence, several debt funds, including many liquid funds which had securities of IL&FS in their portfolios, were badly hit and investors suffered huge losses as ICRA downgraded the ratings of IL&FS borrowing program. This brings to mind some crucial questions. What is the quality of securities in portfolio of the liquid fund? How reliable are the ratings assigned by the credit rating agencies? Does the mutual fund house have adequate risk management systems in place if a rating assigned to a security in its portfolio slips?
Invest in a liquid fund that has performed consistently well against peers and the benchmark. Pick liquid funds with a lower expense ratio, which is the cost of managing the fund. Check the portfolio of the liquid fund for credit quality of the securities and liquidity. And lastly, avoid liquid funds with liquidity issues or credit events in the past.
Well, the bottom line is liquid funds are one of the safest debt funds as they invest their assets in fixed income instruments of short maturity and high credit quality. Liquid funds can be liquidated in a hurry during a financial crisis, making them a better option than bank FDs. The main reason for investing in liquid fund is to keep your money safe along with liquidity. If you want to chase higher returns, then liquid funds are not meant for you. Do not forget to subscribe to our channel to claim your free gift as we have curated 4 of our best calculators to help you estimate the future cost of your financial goals. Let us know in the form that is provided in the description box below. Stay tuned for the next video and take care.